Financial markets are facing a whirlwind of mixed signals. Inflation data, interest rate expectations, stock market leadership shifts, and global trade uncertainties are all making headlines. But the deeper reality is often more complex than what we read in the news. From record-breaking stock rallies to stubborn inflation concerns and geopolitical trade negotiations, it's a moment where separating the signal from the noise is key. The US stock market continues to push higher, with the Nasdaq Composite leading the way, gaining 2.58% this past week. Growth stocks have outperformed value stocks for the second time this year, and while small cap stocks have lagged, the S&P 500 and Nasdaq Composite are now within 1% of their all-time highs. The biggest boost came Thursday, when President Donald Trump announced that new global tariffs would be delayed, opting instead for further study and potential reciprocal tariffs on a country-by-country basis by April 1st. While this leaves some uncertainty in the air, markets reacted positively, seeing it as a sign that negotiations remain open. This rally is a testament to market resilience, even in the face of ongoing challenges. However, rising inflation data and shifting Federal Reserve expectations could test the strength of these gains in the coming months. Inflation remains a key theme in 2025. January CPI report came in hotter than expected. Headline CPI rose 3% year over year, a jump from December's 2.9% figure. Shelter costs made up nearly 30% of the monthly increase, alongside gains in used car prices and car insurance and airfare. Core CPI, which excludes food and energy, rose 0.4% in January, up from 0.2% in December. On top of that, Thursday's Producer Price Index showed higher than expected gains, raising concerns that inflation could stay sticky. That said, I believe we're not facing a full-blown inflation resurgence. Some of these price increases, particularly in energy and food, were one-time factors that may not persist. Additionally, while inflation remains above the Fed's 2% target, it has stabilized around 3.3% for the past 8 months. The key takeaway? Inflation isn't spiraling out of control, but it's also not coming down as fast as the Fed would like. That means rate cuts are still coming, but they might take longer than expected. Federal Reserve Chair Jerome Powell made it clear during his testimony to the Senate Banking Committee that the Fed is in no rush to cut rates. Following the latest CPI report, market expectations for the first rate cut were pushed from September to December. While some headlines have speculated that further rate hikes could be back on the table, I see this as unlikely. Powell and other Fed officials have stated that monetary policy remains restrictive, meaning rates are already high enough to keep inflation in check. Yes, trade uncertainty and potential tariffs could affect inflation, but I don't believe the Feds will react too aggressively to short-term fluctuations. For now, expect rates to stay steady through mid-2025, with cuts likely coming later in the year. One of the most notable shifts in 2025 is the cooling momentum of the Magnificent Seven stocks: Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla. After dominating the market for 2 years, this elite group is now underperforming the broader market. Earnings growth has slowed, competition in the AI space is intensifying, and rising capital expenditures are raising concerns about valuations. But while tech stocks are cooling, other sectors are stepping up. Financials, healthcare, and real estate are now posting double-digit profit growth. The S&P 500, excluding the Magnificent Seven, is experiencing its strongest earnings growth in 3 years. Market leadership is broadening, which is actually a healthy development for long-term sustainability of the bull market. For investors, this is a good time to diversify beyond tech and into sectors with strong earnings growth. European stocks are often overlooked, but in 2025 they are quietly outperforming US markets. Germany's DAX is up 13% this year. The STOXX 600, a broad European index, is up 10%. Both are outpacing the S&P so far in 2025. This rally is fueled by strong corporate earnings, easing trade tensions, and hopes for an end to the Russia-Ukraine war. International diversification is increasingly important, especially with European stocks trading at lower valuations and offering higher dividend yields than their US counterparts. Treasury yields have been volatile in response to inflation data, with the 10-year yield hitting 4.66% before pulling back. While high-yield corporate bonds are holding up well, municipal bonds struggled after the CPI report, though they saw a partial rebound later in the week. For bond investors, any rise in the 10-year Treasury yield above 4.5% could be an opportunity to lock in attractive long-term yields. Let's have a brief look at the Asia-Pacific markets. Japan's stock market continues to rise, with the Nikkei 225 up 0.93% last week. The Bank of Japan is expected to raise rates later this year, but uncertainty remains. Inflation is heating up, particularly in food prices, prompting the Japanese government to release rice reserves to stabilize prices. As for China, Chinese markets rebounded on hopes that US tariffs may be less severe than initially feared. The Hang Seng Index surged 7.04%, led by a rally in AI-related stocks. Inflation remains a concern, but factory deflation continues, highlighting weak consumer demand. While these markets offer potential opportunities, policy uncertainty remains a key risk for both Japan and China. With so much happening in the markets, I believe the best approach is to stay focused on fundamentals and avoid overreacting to short-term headlines. Here's how I'm thinking about my portfolio right now. Buying on pullbacks, particularly in cyclical, value-style and mid-cap stocks. Increasing exposure to international markets, particularly European equities. Taking advantage of high bond yields, especially if the 10-year Treasury moves above 4.5%, and staying patient with rate cuts. They're coming, but likely later in the year. Overall, while 2025 has started with uncertainty, solid fundamentals are still supporting the markets. If we focus on the bigger picture and take advantage of opportunities as they arise, we can navigate the year ahead with confidence. If you would like to see how Meta is outpacing tech in 2025, then click on the video on screen right now. Thank you so much for watching to the end, and as always, happy investing.